All right, Rick. Good afternoon to those of you here on the East Coast, and good morning to the rest of the country. I don't know what it is, if it's the January breakout or Rick, you're just a big draw, but this was our largest attended webinar in probably 2 years. I think this rivals the Bobby Samuelson presentation that we did a couple years ago. So Rick, credit to you, my friend. As the attendees start pouring in, today's topic: 10 reasons why life insurance is a good asset class. Quick logistics: we are recording. Everyone who has registered will get a copy of the recording and a copy of the slides. If you can, please type your questions in the chat. We'll try to cover them and weave them in. More often than not, the questions are pertaining to a future slide or a topic that we planned on touching in a sequential order. So please fire away with your questions. We'll also save a few minutes at the end. This is going to be about 40 minutes in its entirety. And then some Q&A at the end. As Life Brokerage look to set our marketing and education platform for calendar year 2025 and the Republican trifecta in Congress, we wanted to be as aggressive and as informative as we could in other areas of life insurance application other than wealth transfer. I know some of the folks on the call, their bread and butter is wealth transfer, and historically that has been our kind of wheelhouse for the last 20 plus years. But it's also important to identify why life insurance is just a good, prudent asset class to own in the portfolio. So what I did was I invited my friend and associate here, Rick Blaser, to help me with some of the content. He's coming to you from New York Life in the context of whole life. So a lot of the examples you're going to see today are whole life driven, but there's no product affinity here. You can replicate some of these or most of these concepts with your product of choice, whether it be IUL, VUL, whatever you're looking to accomplish and feels that that's fit for the customer. Rick's the regional corporate vice president at New York Life. He supports us at Life Brokerage. He's been working with us for 14 years. Broad understanding of insurance marketplace. He was an advanced markets attorney for another major carrier who did virtually everything in the advanced markets arena. So I tend to go to Rick to learn what should I do and what should I not do when it comes to sales ideas and concepts that maybe are in the gray area. And he's been an unbelievable resource, quite literally helped us write tens of millions of dollars in target premium. And, given his background and experience in the whole life market, I asked him to join the call today. So Rick, thanks for being with us.
Thank you for having me. Glad to be here.
So at this point, let's jump right in. I'm gonna screen share here, and we're gonna start tackling 10 reasons why life insurance is a good asset class. First and foremost, and where this is going to probably take us, in that if you want to be proficient in the life insurance industry and work with centers of influence, then I think everyone on this call needs to be familiar with tax sections pertaining to life insurance. This has something to do with today's presentation, but just a reminder of some of the reasons why life insurance is such a good asset class. And if you're talking about Section 264 and Section 72 and Section 2042, and you're just going to separate yourself. And these are several reasons why life insurance still remains one of the greatest asset classes of all time. I'm going to just fix my presenter presentation real quick, and that should give a full screen. I hope that looks better for everyone in the group. So let's jump right in. Reason number one, Rick, asset location. right? We've been on a pretty good run with this concept in that, when you meet with your advisor and you allocate your assets, you're diversifying the different asset classes between large cap bonds, mid cap, international, emerging markets. Some folks suggest you need alternatives in the portfolio, but no one's talking to you about the location of those assets. Are they ordinary tax? Are they capital tax? Are they tax free? And being diversified in different tax locations helps you in retirement. I'm not going to go through this because we've covered this in a prior call, but this is just the tale of two stories with the same family accessing 350,000 of retirement income through all ordinary assets and climbing the marginal tax brackets to the tune of an effective rate of 21%. They actually hit the 32% bracket. And if you're doing asset location planning by diversifying assets into tax-free bucket, now you have options in retirement where you can access a part of your income as ordinary, stay out of that 24 and above bracket, hit some capital assets for retirement income, and then certainly enjoy some tax-free assets that we're going to be talking about today in the form of cash value life insurance. So, everyone says all high earners say I get killed in taxes. Well, that's not actually true, Rick. Every single one of us on this call pays zero income taxes at $0 of income. Right now, as soon as we start to earn 23,850, every single one of us on this call pays a 12% marginal rate. Every single one of us, Rick, at the next 96,950 hits the 22% rate. So we're all treated equally. It's just a matter of how do you manage the bracket you're in by diversifying the location of your assets in retirement and the source of retirement income. So, there are really just three simple steps to creating your plan. Like, determine the desired mix. Like, what bracket do you want to cap out at? And then you can back into the amount of saving into which location, right? Deposit in the correct location, possibly even reposition non-qualified or capital assets to tax-free. There is a mix and a desired tax bracket that you can plan for, but just using some very simple financial tools. We talk about the three bucket approach, and these charts are somewhat impactful and regular in our industry. But Rick, I want to just turn over to you. Here are clients that are looking to just deploy savings differently, increase that bucket of tax-free assets. How did they do it? Under which chassis? And explain to us how it worked.
Well, obviously from New York Life, our flagship products are the whole life series. So when we talk about people reallocating money, oftentimes what we're looking at is people looking at an alternate kind of bond-like asset that they want to move money into from a planning perspective. But ultimately what we're looking for is a tax advantage income on the back end from these distributions. So oftentimes, just like any investment, the quicker you get it in, the better it's going to look. So we sell a lot, as you can imagine, at New York Life on the whole life basis on a 10-pay chassis for this type of planning. So whether it's single life or survivorship, the survivorship product actually is really good at New York Life. So we look at survivorship quite a bit on this. And so this is just an example here of what it would look like for a 40-year-old. Takes $250,000, $250,000 a year for 10 years, goes into survivorship product. They just like any other kind of investment with an upfront charge, they got a little hit in the first year, but they got 111,000 of cash value, so roughly about 40% cash value year one on this. That continues to grow over time. And in this example here, the clients could actually take out $433,000 of tax-free income from 66 to 90. So that's kind of how we design most of these. And we like to leave some type of residual death benefit when we're done with this. So this particular case, we're taking out about $430,000 of income, and then we're leaving $4.5 million of death benefit left for the family. So this is kind of indicative of what we do. They don't always have to be $250,000, but we do see kind of any multiple of these types of transactions. Sometimes it's single life, sometimes it's survivorship. We can go 5-pay, 10-pay, 15-pay, whatever it is that's best for the clients.
Yeah, and it can always multiply by 5, divide by 10, or this is all scalable. Minimum premium to access the advanced markets division of New York Life is a $20,000 annual premium. So keep that in mind when you're doing your planning. Rick, you want to just talk quickly about your premium deposit account and the ability to just front load all 10 premiums into one shot when you're repositioning assets?
Yeah, so sometimes when we see this type of repositioning, people want to move money quicker than just over a 10-year period or whatever it's going to be. So one of the things that we've done at New York Life, we have a premium deposit account where you can move the money over year one, and then we'll bleed the money into the contract over a period of years. It has various rates over time that we have on the premium deposit account right now. I think it's 5% is the rate, but you can move all the money over in one shot, and then New York Life will automatically pay the premiums on those policies. So this is kind of like, I don't know if it's a great analogy, but almost like your Roth conversion type of thing, right? So you're taking assets from one place and you're moving them into a life insurance policy to kind of get that tax wrapper and letting that build over time. And the beauty of the premium deposit account is we can do that, move all the money in one shot, and still keep the tax advantage nature of the non-MEC structure in the policy. Sometimes do a 5-pay, sometimes a 10, whatever, but it really depends on what the client's looking for. But the nice piece is it's kind of done automatically, and the premium deposit account's not, there's no limit on it other than just it can't be more than the premiums that are paid into the policy. So you can put millions of dollars into this if you wanted to from a reallocation standpoint.
Yeah, we've seen as high as slightly over $10 million get dropped into the premium deposit account. One quick question. So the numbers are kind of hard to see. Everyone will get an email copy of the PDF of the slides. So you rest assured you'll get a cleaner copy of this. Again, Rick, like, doesn't have to be $1.7 million, right? You can do 170,000. You look for debt assets, CD assets, right? And you see a break even on these survivorship contracts somewhere between year 5 and 6, which is remarkable, particularly on an all-base design.
Yeah, I think whenever you're talking about planning and kind of an allocation strategy, people want to know when they're going to get their money back or when they see that they're going to start having some earnings in those contracts. And some of the whole life contracts push out to years 10 or so. Our survivorship contract is unique in that it pushes out by year 6. You normally have gain in that contract at that point. So people kind of like that approach up front.
Yeah.
It's not to say the others aren't good, but that's one of the draws of the survivorship product.
Yeah. So recapping, reason number one why life insurance is a good asset class, right? Tax location planning. Yeah, we're not suggesting you take your life savings and put it into whole life, but if you're checking all the other boxes and you're hitting your match on your qualified money and you're saving appropriately in your capital taxed assets, this is the next logical thing to do. And again, the speed in which you want to drive is completely discretionary. You want mutual fund performance, you want index straddling, or you want whole life. It's completely up to you. It works as long as the asset location is structured within some of those tax codes, 7702, follows section 72 for that matter, just play within the rules. So reason number two, Rick, banking. And 3 years ago, I would have laughed at you because I could have went virtually anywhere and obtained money at 2.5%. Why in the world would I borrow from New York Life or Guardian at 5, 6, 7, 8? It just didn't make any sense. But boy, have times change, and we tend to buy whole life for the bad times. But really, there are two big reasons why you want to buy cash value life insurance. It's not just to hedge against the bad times, but it's to create opportunity. And I think if all 150 plus folks on this call interviewed their very best, wealthiest client and asked them, how did you become so wealthy? They were going to say to you, opportunity. I bought at the right place at the right time. I started a business at the right place, right time. I caught a distressed piece of real estate at the right place, right time. Whole life gives you IUL, low cost structure IUL gives you that opportunity. Rest assured, in the next 60 months, an opportunity will be presented to you that you need to act on quickly in order to generate long-term generational wealth. Rick, talk to us about opportunity and some of the roadblocks in obtaining capital from other sources that aren't your policy.
Well, I think the biggest thing is speed and headaches, quite frankly, right? So when you're looking at going to a lending facility, someone calls you and said, hey, Anthony, there's a really good real estate deal. I want you to jump in as a partner on this deal. and invest with me. And then you say, okay, that's great, but I got to go to a lender and I got to get the capital to do that. And that may not be as easy as things, particularly if there's other investors involved in the deal that the bank doesn't know. Okay, so there's that aspect of it. Then there's forms and waiting and all that other type of stuff that goes along with that. And the life insurance policy, generally speaking, within a week or so, you're going to get your money if you call up the life insurance carrier with no questions asked on a policy. So, and the time is only a matter of how long it takes a person to process the payments realistically, right? So there's no questions asked when it goes in, when the money comes in and out of the life insurance policy. And if you're working with a non-direct recognition carrier like a New York Life or some of the other carriers that you have, you can take the money out of the life insurance policy, and if you repay the money, the policy is in the same position it was in, regardless of whether or not any money was ever taken out of that policy. So we've seen an uptick in this type of stuff. I think it's because you can turn on any of your social media apps and you can see a whole bunch of people talking about this type of concept. I think some correctly, some probably incorrectly, but ultimately the idea is sound, that if you had a side bucket of money that you could draw from without any income taxes, that you could take out money to use for whatever purpose you wanted to do and then repay it with little or no impact on that investment, it really ends up being a pretty attractive strategy for folks. And we've seen people dip into the life insurance policies for all kinds of reasons. But to your point, Anthony, opportunity knocks. You want to take advantage of it. You don't want to be in the middle of a banking process to try and get your money.
Yeah, one of the best things we did as a company, we took out a couple New York Life whole life policies at the beginning of COVID because we were afraid the world was coming to an end and wanted to diversify some savings, create our own bank. Banking was in a little bit of a frenzy. And today it was one of the best moves we've ever made. We can hit New York Life for 5.3%, whereas my Fulton Bank working line of credit is 8 plus, and it just doesn't make a lot of sense. So different times are going to create different opportunities. Rick, in a perfect world that we see sometimes max blended whole life 90-10 with Northwestern or high early cash value IUL, what's the optimal way that you would get out of the gates with a policy if you were going to access the funds earlier than anticipated? And I'll say some of our top performing agents, employ this strategy to buy real estate. But it's a little bit of a longer burn because they need 4, 5, 6 years to have meaningful values in the policy. What happens, Rick, if opportunity presents itself now? How are you designing optimally this type of policy for this type of strategy?
Yeah, it's interesting you mentioned that, because the reality is that if you have a life insurance policy, regardless of the product, carrier, whatever, the longer it cooks, the better it's going to taste, right? And so that's kind of how you want these things to be. However, the kind of client desire is to have money immediately right away when they put their money in the policy. So if that is the case, what we try to do is stuff as much money as we can in the policy. In the context of whole life, we do that in the form of paid up additions. We put as much money as we can into paid up additions early on in the contract, because the paid up addition value goes essentially directly to cash values. Okay. And so if you look at this example here, this is stuffing the policy with the most amount of paid up additions we can get. We can get about 80% cash surrender value in the first year. So we see some of that from a design perspective. I will tell you that most of the time, once the producers are going to look at it, they tend to go for a little bit longer approach before we start taking money out. But we can go as low as 80%. Generally speaking, there's a hit to the long-term performance if you go and try and get early cash values as early as possible in these contracts. And when people start to look at it, they say, you know what? I don't really need the money tomorrow. Okay. So if I can wait a couple of years to do this, you're probably better off to not stuff it so much. But we certainly see a fair number of these driven primarily by consumer demand with respect to getting early cash values in the policies. So
yeah, particularly when you can shift gears if you have the luxury of having a spouse and create a break-even structure by year 5 in the survivorship contract. It's just
yeah.
And not to mention some really new innovative whole life line of credit lenders out there today that make it really easy, tech driven financial companies.
What's interesting on the line of credits, Anthony, is that it used to be the line of credit rates were better than the policy rates, and now the policy rates are better than the line of credit rates. So people are refinancing the lines of credit with the actual policy loans on their policies, and that goes back to what you were saying about the bank rates versus the policy rates. A couple of years ago, it was completely flip flopped.
Yeah, You're also a little spoiled, Rick. You have really competitive, loan rates. Not all blue chip mutuals have that luxury.
We'll take that compliment.
All right. Reason number 2 is banking, right? Reason number 3 is buffering. We have beat this concept up over the last several years, but I continue to say that this really defined my outlook and career on how I look at cash value life insurance. And I could not for the life of me fathom how successful whole life producers were selling whole life insurance with a break even of year 10 or 12 or 15 or 19 when we had the 65 or pay to 100 programs. But it really started to click when I understood distribution rates. And getting up that mountain, accumulating assets is one thing, but getting down that mountain in an orderly fashion, which sequence inflation, medical issues, and taxes don't affect your free fall to the bottom. Cash value life insurance really, particularly whole life, really started to resonate with me. So I would say this: your lifestyle with buffering is better than without buffering. If you had all investment assets, the every financial expert will tell you you can spend between 2 and 4% of those assets, total them all up, get to the top of the mountain, and you can spend 2 to 4% depending on the expert that you're following. If you have a buffer asset, quite frankly, you can double, maybe triple that number and spend 5 to 7% of your assets because you have a non-correlated asset in whole life or IUL that you can pull from in the years following a down market. And I won't get too far into the weeds with this, but you can see where the volatility buffer lands today. If you're not interested in buying a life-only annuity, or you don't want to give up access to your principal and you're not 65 years old, then the volatility buffer, investing in equity assets and complementing that with cash value life insurance, is by far a better way to generate optimal income. You're thinking in income, not accumulation, right? I'm not going to continue down the 4% rule, but just to justify here, that 2 to 4% number here. Here are all the financial firms and financial experts and analysts who would agree with that 2 to 4%. And what I'm going to show you here is just very simply accumulating assets. Averaging a rate of return of 8% gets you to the same point no matter what order it performs in, as long as you average 8%. Conversely, if you're 69 years old and portfolio A starts with 3 losses, -9, -12, -22, you are just simply not recovering if you don't have another asset to pull from and give your equities a chance to recover. Right? You see the difference between portfolio A and portfolio B. Slow start in portfolio A, fast start in portfolio B. You run out of money by year 13 in portfolio A. You have a residual of $2 million at age 93 in portfolio B. So the sequence is really, really important. If you create a buffer asset like IUL or like whole life, and you can take the years following a -9, if you can take the whole life in the years following the -12, if you can take from your whole life in the years following the -22, you will be exponentially better. And not only will you create better outcomes, but it's the permission slip to be more aggressive and to spend 6 or 7% of your assets, not 2 to 4% of your assets. It's a game changer. Buffering is the third reason why life insurance is a good asset class. Reason number 4, Rick, I love this one. New York Life did asked Morningstar to write a white paper several years ago. I know it's a little bit outdated and we kind of shelved it, and I'm sorry for bringing it up, but I'm going to bring it up anyway because it did educate me on why whole life is likely a more steady, predictable, tax efficient asset than the largest and best performing bonds in the world. And if you couple that fixed income alternative with a concept that Rick, you introduced me to, what I call the net 10 bonus option, not only do you have a more efficient asset by way of growth in fixed income, but you have the net 10 bonus option. So let me just jump into this real quick. I'll set the table. Rick, I'm talking about the largest and the best performing bond funds, 10-year return, 1.33%. The best performing bond fund, 10-year return, 4.27%. Bond returns are not guaranteed. They're not linear. They are misrepresented or misunderstood quite often. And that is supported by an extremely effective white paper that Ernst and Young published that uses cash value life insurance as a fixed income alternative and a buffering asset, and combining that with all of the other financial tools that we talked about earlier. You're qualified, you're non-qualified, as long as you're diversifying your asset classes and the location of your assets and the type of assets, you're going to get to an optimal point in retirement. So, right, the basis of the Morningstar paper, and I think fast forward a few years after it was written, it all came to ring true, right? Where a whole life provides guarantees and dividend potential. It grows more steadily than bond funds. You get the same or better outcomes, arguably better, and you're getting the tax efficiency, the buffering, the banking, the potential supplemental tax-free income, and the death benefit. So Rick, talk to me about whole life as a fixed income alternative, and then let's talk about this net 10 bonus option if you want it.
Well, I think the alternate asset approach with the whole life is that you can get your bond-like returns from a mutual carrier like a New York Life. Our investment portfolio is probably more diverse than just about anybody could do on their own from a diversification standpoint. And you can look at the performance over time on the products and how they've looked from an alternate to the bond alternative, if you will. The question is, how much do you want to put into these types of investments, and for what purpose? So obviously you can see the numbers on the slide. This is a very high net worth individual here that's looking at moving money over. And what I've found is kind of interesting is when you start to talk to people about buying life insurance, no one wants to buy it, right? When you start talking about spending their money to buy this, it's one thing. But if you start to talk to people about using their money instead of spending their money, it's a completely different outcome that people have. And a lot of the people that we do business with, and I'm sure the folks on the call the same way, they're business owners. And so business owners want to know what's their investment, what's their liquidity event going to happen with their investment. Okay. And so one of the things that we've been pretty successful at selling is a situation where we show a client, hey, look, instead of spending your money, let your trust or let your life insurance, or let's use your money to buy life insurance. And at some point in time, we'll structure a liquidity event here for you where you can get repaid your principal into the deal and then still have some net number, whether it's net 10 in this concept, net 5, it could be net 1, whatever it is. But ultimately, it's this idea of a liquidity event down the road that's going to effectively reimburse the clients for their contributions to the insurance policy. And if you think about it, it's the same. I put premium finance on the slide because it's also, we use this type of design in some cases in a premium finance context. But ultimately, what people will tend to do in this, depending on where, going back for the cash value lines of credit and things like that, if you fund this policy, this survivorship, you put the 639 in for 5 years. In year 6, your cash value equals premiums paid. So there's a good chance someone will go fund this for 5 years. Then in year 6, what they'll do is they'll go get a cash value line of credit. They can take their money back. So the first liquidity event may actually be in 5 years. And then they'll service debt on the interest or finance the next 5 years and then pay the lender off in year 10 or year 11 with the cash value. So again, it's really about moving money from pocket A to pocket B and what's going to drive people to do this. And to the extent that you can show the owner they're going to get something for their contribution, it makes it a much easier conversation to have.
Well said. Do a little built-in liquidity event, Rick, if you like it, right? If you like it and timing is right.
Mm-hmm.
So okay, reason number 4, fixed income alternative with a net 10 bonus option. Let's move to reason number 5, super Roth / long-term care combo. I'm gonna just jump over here for 1 second. Numbers that everyone wants to know. 246 and 7, right? 246 and 7. What does that mean? That means if you're married filing jointly, you cannot contribute to a Roth IRA if your joint income, modified adjusted gross income, is 246 or more. And if you meet the criteria, even if you are under that 246, you are limited to a $7,000 annual contribution. You could increase it by $1,000 if you're over age 50, which is $8,000. So there are income limitations and contribution limitations. Where we talk about, life insurance as an alternative to the super Roth, right? Again, remember 246 and 7, they're the numbers you want to know, in addition to all those 8, code sections that speak to life insurance that we showed earlier. Rick, talk to me about why does life insurance, cash value life insurance, distribute so well and equities distribute at a rate so low? So if we kind of subscribe to the investment only portfolio distributing 2 to 4% of the total asset value, how come life insurance can distribute at 8 to 10% of the asset value?
Well, I think you look at the numbers to see, how close we get to the 8 to the 10 numbers on there, but it depends on the product and so on and so forth. But ultimately, it's the linear growth underneath the life insurance policy and the fact that there's no acquisition cost effectively to access that money, which drives the performance. We like to say it's not what you earn, but what you keep. Okay. So when you have money inside a life insurance policy, all that money that's there is yours to keep. So you can take the money out of the policy with it doesn't matter whether there's a capital gain involved or not, and that money on a linear basis is going to recover itself in some cases the following year, given the linear returns, particularly in a whole life contract.
So when you're talking about linear returns, Rick, you're talking about positive growth year in and year out, where we don't have to factor in for a bad sequence of return or poor performance. Is that what you're saying?
Correct.
So Rick, the life insurance naysayers would argue, oh, you're only able to distribute such a high percentage of the asset because you're arbitraging in your illustration system the growth minus the loan rate. That actually is not actually true. You can still distribute at 6, 7, 8, 10% distribution rates and not even have an arbitrage in the loan rate.
It just depends on the product, but I'm sure you can take the money out of the product and you're getting the fact of the matter is you're going to get some recovery every single year from the policy on effective in a whole life on a guaranteed basis. You're going to get some recovery of cash value each year, and that's helping drive those distribution amounts on the back end of the policy. That's effectively what's going on there. You're taking money out, it's recovering to some extent each year, and that's what's worked.
Yeah, so I wouldn't disagree with some of the IUL critics with some of the illustration games that were being played, right? Where he's showing years ago 300 basis point arbitrage for the next 4 decades, or even 100 basis point arbitrage for the next 4 decades. But the reality is, in today's market, even at New York Life, for example, the IRR on cash is not matching. It's not exceeding the 5.3 loan rate in most scenarios. So it is not because of the loan arbitrage. It is because of the linear growth and the function of withdrawal to basis and loans thereafter, and the supplementation of the recovery of the loan interest in the policy growth. So it's an interesting point that I think everyone needs to know if we're going to segue into structuring a super Roth IRA, which goes back to, right, the 246 and 7 numbers that everyone should be talking about to their high earning clients. Rick, talk to us about how you can deploy this any way you wish, and a little bit about structuring a super Roth, even pre-retirement and post-retirement.
Yeah, I think everybody on the phone call, we just went through a presentation with a premium of $600-something thousand on the last slide we looked at. Okay, so this is more something that probably everybody on the call has clients that meet this profile, whereas they're making more money than they are spending. They need a place to put money. So just here's a simple example. Someone puts basically $2,000 a month to $24,000 a year into a policy. One of the things that's kind of neat that I like to show people is there's tax penalties if you take money out too early from a qualified plan. So oftentimes this goes back to kind of your buffering strategy, Anthony, that you say, okay, so what I like to show people is you can take some of the money out from, say, 56 to 60, whereas you couldn't take that money out of a qualified plan. So this gives you the ability, and it's all about lifestyle, because I like to say we're selling a dream here, right? Where clients are looking and saying, hey, I want to retire early. I might want to do something else, whatever it's going to be. So we're putting them in a position to be able to do that, by saying, look, we can supplement your income to the tune, in this example here, of $35,000 a year tax-free money for those years, which may be before retirement, maybe during early retirement, who knows. But then what I like to show people is to 35,000, in this case here, 35,000 a year for 5 years up until age 60. And then we can tap in to the traditional retirement vehicles and things like that they've been saving for the meat of their retirement. And then what I like to do is show the income kick back on at, say, 80 years old or so on and so forth. So we let the life insurance kind of bake a little bit longer on the back end. And so what that's doing is it's just another way to look at that buffering strategy. Because if a client knows that they're protected on the back end, that's going to give them some freedom to be able to take more money out during retirement and let them live the retirement that they want to live without the fear of running out of money. And that's ultimately what we're trying to give people the opportunity to do, which is live a better lifestyle by incorporating life insurance into their overall planning. And of course, they can do all the things you talked about with taking money out the year after a down year and so forth. And we all seen many illustrations that show income from 60 to 85 or whatever. But I assume everybody on the call seen those illustrations, has worked that approach. And all we're trying to do is give you a different idea and some different ways in which you can position the life insurance and distributions that may help the client long term.
Well said, my friend. Well said. All right, so reason 6, create your own super Roth. The key numbers to remember: 246 and 7. Right, I'm sure you have clients that kind of are outside that scope. Reason number 7, Rick, can you use cash value life insurance as an LTC supplement, or do you have to go out and buy a whole separate LTC policy?
Well, I don't think we want to tell people not to buy long-term care, but you can use life insurance cash values for anything you want. I think that's the message here for people, right? Is if you took a policy, and we've done a number of these types of designs, but what we're doing is selling life insurance on top of what they've already done from a planning perspective, because maybe they're concerned about a couple things. Maybe they're concerned that they don't have enough long-term care coverage, okay? Maybe they're concerned that given their lifestyle, maybe they're international clients, whatever, there's not going to be the ability to get as much long-term care as they want out of that policy, or maybe they want some money without having to fail 2 out of 6 ADLs, right? And so what we do is show them an example. This here, again, maybe this example was putting $20,000 a year, 250-year-olds into a survivorship whole life contract. And what we could show people is, let's take distributions. A lot of the hybrid products are sold with a 6-year benefit. So I just use a 6-year benefit starting, or ending, I should say, with the year of life expectancy. So we're illustrating life expectancy age 90 here. What I like to do is show people, look, if you bought this survivorship policy, you put in $20,000 a year for 10 years, it's going to last the lifetime of you and your spouse. And if we look at taking distributions 6 years prior to life expectancy, we could take out $12,000 a month, okay, to supplement your long-term care planning you have, or provide for things your long-term care planning is not doing. And if you never use it, you're getting 5 times what you paid for $1 million. You're getting to leave to your heirs. So the nice thing is, if it's a life insurance and you don't use it, it's the best asset you can leave to your family. The other thing is, I'm a big believer in making sure that you have flexibility down the road. And I think that when you're looking at 35 or 30 years out, there could be a better mousetrap than what we have today. Okay. And so the ability to move money around into other assets or to do things differently is tremendous. And so I just look at my own family, and we won't go into the whole story here, but you look at some of the things that's gone on in your own life. I'm sure you've seen a situation where you say, hey, I wish this person had a little bit more money to do something, and maybe they didn't fail 2 out of 6 ADLs, but they didn't have a source to take that money to live the lifestyle they want. And so having life insurance either before they fail 2 out of 6 ADLs, or to have cash values on top of that, can be a really powerful tool, especially when people start thinking of buying too much long-term care, because their big concern is if they don't use it, they'll lose it. And so this is the idea of, if you buy this and you don't use it, you're going to leave a legacy to your family, which is what a lot of people want to do. So,
well said, Rick. And you make some really interesting points in the margins here, where you can transfer a policy to trust and loan it back out to the estate, which is a whole nother white paper we've been promoting that our dear friend Allison Hoyt at Nationwide authored. You talk about international benefits, right? In some of our markets, New Jersey, New York, Florida markets, Texas markets, international benefits are really important. So it again, reason number 7 why cash value life insurance is just a good asset class to have in the portfolio. I'm going to shift gears a little bit and talk about why it's a good asset class to potentially hedge against this political football topic of estate tax. Rick, walk me through why you would want to structure the survivorship policy that we talked about earlier, or a single life for that matter, with a dividend option term rider and some of the unique features about this dividend option term rider.
Yeah, so I mean, high level, what we're trying to do here is I don't think anybody could pinpoint what they think the actual or what the estate tax is going to look like, if at all, in the future, right? We've seen so many changes that people want flexibility, but they also want to be protected. So what we're trying to do is figure out in some of these examples, we're trying to figure out what's kind of a baseline level of coverage that someone wants, and then what is the amount of coverage they would like to have if it didn't cost very much to have, right? And that's kind of where we're going with this. So if you were to take this example here is a $10 million policy. If you were to buy a $10 million 10-pay whole life, it would cost $388,000 of premium for this particular policy, okay? And so what we've been pretty successful at is designing these so that what we're doing is we may buy, in this example, we're buying $2 million of base coverage, which costs $77,000. And this is a clear plug for New York Life, Anthony, but New York Life has a survivorship term rider that we have that is based on joint mortality. One of the few carriers out there, if not the only carrier I know that has that type of rider, okay? So ultimately, if you wanted to buy an $8 million term rider associated with this survivorship product, the term rider costs out of pocket be $1,360 for 5 years. So clients can get the $8 million of coverage for $1,360 a year for 5 years. After year 5, it's paid with the dividends in the policy, but ultimately the rider is convertible for 10 years or up to age 60. So what we're seeing here is people say, look, why not throw on the extra $8 million of coverage in this example here. If I don't need it, I'll cancel it. And if I do need it, I'll convert it. So it drives business. It gets people to act, which is sometimes a challenge we have. And I don't think we're going to cover it here, but it's also a great way to get into a premium finance deal where someone's saying, hey, look, I don't want to finance it because the rates aren't where they need to be. Someone turns around and says, you know what, I'll buy 20%. And when the rates get to a rate I'm comfortable with that, then I'll convert the whole thing into permanent coverage. So really, really interesting technique here. And if you never touch it and just let the term rider stay on there, it stays out until age 88 in most scenarios here. And your cash value still continues to grow because the drag on the policy is minimal with the term rider.
So Rick, if your foundational asset class purchase is $2 million and you're contributing $77,000, you have all these wonderful attributes, break even year 5.5, creating a tax-free bucket, you utilize it for banking, buffering, fixed income alternative, net 10 concept, like all the cool stuff we talked about. You're telling me you could also incorporate some estate planning flexibility by adding $8 million of term for $1,300? It just sounds like a no-brainer. Why wouldn't you add that to complement any estate planning need, current or future, to the already sound purchase you've already made? It's a no-brainer. Fully convertible, I may add, correct?
Yeah, I mean, the whole point of these is to convert these once the client gets comfortable with the fact that they need the coverage, right? And unfortunately, who knows how long that's going to be? The political football goes both ways, so we don't know what the estate tax is going to look like. But this is just another way to create that hedge.
Yeah, well done. Another little estate planning trick is to buy the same policy, and again, doesn't have to be survivorship whole life. Could be survivorship VUL, IUL, again, whatever your flavor is. But you make that foundational purchase here on the left, and you're generating cash value inside the plan with an increasing death benefit, and you're potentially enjoying some banking opportunities, your buffering opportunities, your tax-free bucket opportunities. There's a very simple technique that you can utilize if you go out and create what's called an irrevocable life insurance trust. And on the application, when you're making your application to New York Life or any carrier for that matter, you just very simply when you're buying a survivorship chassis, you just very simply, and you're owning it personally, you just very simply name the contingent owner as that irrevocable life insurance trust, so that upon first death, the policy then moves, provided you have adequate exemption limitations, after you've enjoyed the tax location, the buffering, the banking, all these wonderful, the fixed income alternative or whatever you're looking to do, even some tax-free income distributions. You then pass the policy while one one insured is still alive to that trust, you recognize and file the gift tax return at that point, typically for an amount equal to the cash surrender value. And then you have your death benefit that now sits outside of the taxable estate in that irrevocable life insurance trust that you want to button up is with grantor status and dynastic language and do all the things that Congress wanted to take away from us just a short while ago and make sure that trust is in place. It's just a simple add-on beneficiary designation as a contingent beneficiary, and you have your quasi estate plan completed. Again, using the same exact policies that we've been talking about with all these other great attributes. And then number 10, Rick, reason number 10, retirement buy sell. Talk about what the increased exemption limits and have done for this strategy. A recent court case in the form of Connolly versus US that is kind of forcing some clients to look at cross purchase or moving policies outside of their businesses and the opportunity to control your own money. You want to touch on this, or you want me to take this one?
Sure, that's fine. I mean, I think ultimately with the impact of Connolly is effectively an impact to entity purchase agreements that are where life insurance is owned by the company. Okay. But what's interesting is the biggest concern with this thing is the state tax consequences of having these policies, the value of these policies included in the fair market value of the business. Okay. But what's interesting is with the exemption amounts being so high, it's opened up a whole lot of other planning opportunities. And I think you can comment on that, but it's opened up a whole lot of other planning opportunities that you may not have even thought about doing with a lower exemption amount. And so everybody needs to get their buy-sell agreements reviewed, whether they have a Connolly impact or because there's just better options that might be available to them now that the exemption amounts are high. So it's kind of like the high level gets rid of some of the estate tax issues. And if you do have an estate tax issue, then you have to look at the impact of Connolly on your plan. So almost everybody, or pretty much everybody, has to have their plans looked at or should have them looked at.
Agree wholeheartedly. So in this opportunity, we're able to structure a 10-pay whole life policy that we own individually. Right. So this is a policy on my life, 48-year-old male, $5 million death benefit, 10-pay commitment. I'm able to own this policy outside of the business, own it personally, and I can then rent the death benefit, the pure death benefit net at risk to my partner. He pays me the economic benefit, which is in coordinates with the New York Life 1-year non-renewable term rate. And for that, I'm essentially assigning him that portion of the death benefit to fund a cross purchase buy sell agreement. Now, what's great is that we have several years difference in age. We are an S corp, and we have to take distributions accordingly to the percentage of ownership. It becomes very complex to get him the amount of premium required to buy my life insurance on a true cross purchase. And I just did a 45-minute presentation on why cash value life insurance is a good asset class. Why would I want Adam to have it if I'm going to enjoy it, right? And vice versa. He believes the same thing. So I want to control and own my own values. I will rent the death benefit for term cost to my partner. He's going to do the same thing for me, and he's probably a bigger fan of cash value life insurance than I am. And at death, it's just very simple. The rented proceeds, are used to purchase the shares of the surviving spouse, and that's not our plan. Our plan is to live and exit the company alive, and we just cease the rental agreement per se. I own my policy, Adam owns his policy, and it's the 10th reason why life insurance is a great asset class. So, I'm pretty sure, Rick, we could have come up with 20 reasons, but we didn't. We held it to 10. We've hit every single question along the way. I've even either typed out the answers or incorporated into our slideshow. I want to thank everyone for attending. Again, this was our our most well-attended webinar as far as I can remember, and possibly ever. So I want to thank you for your participation. A copy of the webinar will go out along with copies of the slides. I want to thank my co-presenter here, Rick Blaser. Rick, you did a great job as usual.
Thank you. Appreciate the time of being here.
So at this point, we'll adjourn the meeting. Everyone have a terrific remainder of your week. Stay safe and go Eagles.